Ladies and gentlemen, good day and welcome to Godawari Power and Ispat Limited Q3 FY26 earnings conference call hosted by Go India Advisors LLP. As a reminder, all participant lines will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand over the conference to Ms. Sana Kapoor from Go India Advisors. Thank you and over to you, ma'am.
Thank you, Pari. Good afternoon, everyone. It's my pleasure to welcome you on behalf of Godawari Power and Ispat Limited. Thank you for joining us today for the Q3 and 9-month FY26 earnings call. Please note that today's discussion may include certain forward-looking statements and must be therefore viewed in conjunction with the risks that the company faces. We are joined today by Mr. Abhishek Agrawal, Executive Director, Mr. Dinesh Gandhi, Executive Director, and Mr. Sanjay Bothra, Chief Financial Officer. May I now invite Mr. Dinesh Gandhi to present the company's business outlook and performance, after which we will open the floor for Q&A. Thank you and over to you, sir.
Thank you, Sana. Good afternoon, everyone. Thank you for joining us today on this call. Our financial results and earning presentations are available on our website as well as on the stock exchange. I believe that you had a chance to review them. I will take you through the results, post which we can have a question and answer session. I am pleased to share that 9 months FY26 marked a steady performance with slight decline in the revenue across operational and financial front. Revenue remained, stable with slight decline. EBITDA and PAT margin stood strong at 22% and 14% respectively, despite softer realization. Operating momentum remained strong in Q3 FY26 on YOY basis, with iron ore mining production increasing 46%, while iron ore pellet and value-added product remained steady growth. Pellet sales temporarily declined during Q3 FY26 on account of accident in the pellet plant in end of September 25, which impacted production and sales volume during Q3, whereas value-added steel products sales grew 15% YOY. Realization for YOY 9 months and quarter softened across almost all product categories except hair oils and galvanized product. In Q3, on year-on-year basis, EBITDA margin expanded to 20% from 17% in Q3 FY25, despite a marginal decline in realization and pellet volumes. On a quarter-on-quarter basis, sales EBITDA and PAT moderated, largely due to lower pellet sales volume and softer realization for intermediate and finished product. Notwithstanding these challenges, margin remained resilient with EBITDA and PAT margin sustained at 20% and 13% respectively, reflecting company's strong operational efficiency and margin stability. Q3, during 9 months, production volume showed healthy growth, with iron ore mining and pellet increasing by 27% and 10% respectively, while value-added product remained largely stable with modest 4% growth. On sales front, pellets had an increase of 17%, whereas it was slight dip of 3% on value-added product. Coming on consolidated financial performance for 9 months, revenue dipped slightly on account of softer realization, which were to some extent offset by higher production and sales of pellet, galvanized fabricated product, and rolled structural product. EBITDA and PAT were lower, primarily due to decline in sales realization. Still, EBITDA and PAT margins remain strong at 22% and 14% respectively. Now, coming on company's growth plan and the updates during 9 months of the current financial year, I am happy to announce that GPIL has received much awaited environment clearance from Ministry of Environment, Forest and Climate Change for more than doubling the iron ore mining capacity of the Dongri mine from 2.35 million to 6 million tons. The consent to operate is expected to be received in few days, following which commercial operations of the iron ore mining and ramp up of capacity will start. hopefully, during the current month itself. This marks a significant milestone in strengthening GPIL raw material security, backward integration, while reinforcing its long-term visibility and competitive positioning. Environment clearance and consent to establish for 5.4 million ton crushing and beneficiation plant has also been received, and we expect to complete the work for beneficiation plant by end of Q2 FY27. I'm pleased to highlight that additional 2 million ton iron ore pellet plant has commissioned and operations commenced in December 25, with commissioning of GPIL total pellet manufacturing capacity to more than 1.7 times, 1.7 times from 2.7 million to 4.7 million ton. It's strengthening its integrated operation and supporting future growth. These achievements will drive volume and profitability growth in FY27. Progress on 0.7 million ton CRM complex remain on track, with land acquisition completed, major equipment order finalized, and bank funding secured. Construction will begin in April 2026, commissioning targeted for March 27. GPIL is also expanding its captive solar capacity by over 3 times from 165 megawatt current to 540 megawatts to support captive consumption across iron ore mine, integrated steel plant, and CRM operations. Land acquisition for solar expansion has been completed. Execution is currently underway, and these projects are expected to be completed in phased manner, beginning for March 26 to March 27. In order to operate these projects in more efficient manner and save on the cost of banking, the company has recently decided to set up a battery energy storage capacity of 45 megawatt hour in one of the solar projects to meet the power requirement of captive iron ore mine, where grid tariff is highest at about 11 per unit. These equipments which are being ordered will be the same composition which our base manufacturing facility will commence over a period of next 1 year. Additionally, as you are aware, company has decided to venture into manufacturing of battery energy storage system with an initial capacity of 20 gigawatt, with a capex of 1,025 crores during 2026-27, and commissioning of base project is targeted for Q4 FY27. The decision to take up base project with a capacity of 20 gigawatt is driven by availability of single line 20 gigawatt manufacturing line, which enables better land utilization, structural, lower structural and operating costs, improved manufacturing efficiencies, and supporting higher operating margins. As a part of company's ongoing efforts to simplify and streamline group structure, the board has approved this investment of its entire 37.85% stake in Ardent Steel, which operates a merchant iron ore pellet plant. This stake is being divested for a approximate value of 91 crores. This transaction is expected to be completed by March 26. Coming on the ESG, front, the company has completed major initiative under its energy efficiency decarbonization project, resulting in higher average DRI production, increased daily steam generation. The company achieved a score of 76.6 from CareEdge ESG rating agency, reflecting its recognition as an industry leader with strong ESG risk management and performance. The company continues to make steady progress towards its long-term goal of achieving net zero carbon emission by 2050. Coming on the market outlook, on international front, global iron ore prices remained range bound, during FY20, during calendar 26, at USD 95 to $110 range, and currently stood at about $102, supported in H1 by weather-related production losses. However, rising supply is likely to keep the prices going forward. China's steel consumption has officially peaked and is expected to gradually decline, although recent stimulus measures including direct cash transfer, should provide near-term demand support. Global iron ore market is at an inflection point with a supply addition such as Genoa's Simandou project commencing operation in November 25 and expected to export 5 to 10 million ton in calendar 26. Full ramp-up will is expected to take longer. Iron ore prices in 2026 are expected to be range-bound, averaging around $100. On domestic front, NMDC iron ore prices have remained largely range-bound at 4,500 to 5,500, excluding seasonal fluctuation. Current prices at 3,900 reflect the revised structure with statutory levies excluded from January 2026. Pellet prices have tracked a similar trend, trading at about 8,500 to 10,000 during calendar 26, with current prices at around 10,000 rupees a ton, which is expected to remain stable during FY26. India's steel demand is expected to grow steady through the calendar 26, supported by infrastructure-led growth, with budget 26 allocating 12.2 lakh crore towards infrastructure capex, providing strong demand visibility. We believe that iron ore demand in India is expected to remain strong in view of demand growth from newly commissioned and ongoing projects. With imposition of safeguard duty, the prices of finished and intermediate products across value chain have risen by 5 to 10%, which is expected to support profitability in 2026 and onward. In conclusion, leveraging competitive strength of captive iron ore strength position and ongoing capacity expansion, company is strongly positioned to deliver sustained growth, value creation underpinned by efficiency gain, solar-led cost optimization, and firm commitment to ESG. With this, we can open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Siddharth from Equirius. Please go ahead.
Hi, sir. So the first question is on the capex. So how should one think about the capex over the next 3 years? What would be the cash outflow over 26, 27, and 28?
See, Siddharth, our capex till now is finalized till end of FY27. The capex in solar to reach a capacity of close to about 500 megawatt plus base and CRM. All these projects we are expecting to commission by March 27, and beyond which we have not yet announced any further capex. So our capex in the next financial year, of course, is an heavy capex, but with our strong balance sheet of around 1,000 crore of cash reserve and debt tie-up for the upcoming project, except base, we are fully tied up with requirement of our cash flow for FY27.
So what would be the total capex for FY27?
Our FY27 capex will be, close to about 2,000 crore, plus minus 200 crores.
And so for this year, how much have we spent till now, and how much will we spend in the fourth quarter?
This year, I don't have the exact number right now, but we would have spent, close to about, 6 to 700 crore in the current financial year.
So second is on the iron ore mine. Now, given that we are expecting the CTO also coming in this month itself, how should we think about the mining volumes for FY27?
Okay, so Siddharth, just to answer that, the CTO, we're saying we are very much hopeful the CTO should receive very soon, maybe this week or maybe next week. So yeah, but that is received. So there'll be a very slight increment in the production for this year, probably, because only 1 month will be left for this financial to get over. For next year, from 2.35, we're looking at a capacity of 5 million. And then the next year, which is April 27 onwards, we're looking capacity of 6 million tons. So that's how we plan to, ramp up our mining capacity.
Okay. So next year we should reach to around 5 million ton, irrespective of when the beneficiation facility comes online?
Yes. So I'll tell you what will happen is, so by October, November of October 26, we should be able to start producing at a rate of 6 million tons. Because of the delay, so we'll get only 3 months of dry season in this, next financial year, then monsoons will come. So eventually by monsoons, the idea is to get the plant up and running. And from October onwards, we want to run the beneficiation at full capacity along with the mining. That is the entire planning going forward.
Okay. The last question on the pellet capacity. So even FY27, we should reach somewhere around 75% utilization?
No. See, before the new plant was commissioned, we were operating close to at 90% capacity. And our plant has been running well from last 2 months. And for next year, next financial year, we will operate at more than 90% capacity.
Oh, the entire capacity?
Yes. So we should be able to produce more than 4.2 million tons from next year onwards.
Okay. So lastly, on the steel plant, any thoughts on the steel plant, or we will take it up somewhere next year only now?
No, see, so as we had said earlier as well, we were waiting for the mining EC to get received because we didn't want to, overcommit on the capex side. Now, since mining has been received by EC, so the team is working on the last minute details, and hopefully, if we will discuss internally, and if we want to go ahead with the steel plant, I think the proposal would be taken in the next board meeting.
Oh, okay, sir. Got it. But this will be a 1 million ton steel plant only that we will be.
Yes. It will be agreed to different new location, 1 million blast furnace through steel plant. Primarily.
Okay. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1 on their touchtone telephone. I repeat, participants who wish to ask question may press star and 1 at this time. The next question is from the line of Vikas Singh from ICICI Securities Limited. Please go ahead.
Good afternoon, sir. So my first question pertains to Dineshji's remark on the iron ore supply scenario. So one of our competitors like Lloyd has also came up with a large supply. So are we going to see some excess supply in the iron ore space in the domestic market as well for the next 6 to 12 months perspective? And is that our assumptions? And would that impact our overall performance?
See, so I would like to break this question into 2 parts. In terms of volume supply from Lloyds, definitely there will be a additional supply coming in from Lloyds. Apart from our new pellet plant, and there's one more person who has commissioned the pellet plant in this area. But at the same time, the domestic demand has gone up because people are still, commissioning their new DRI cylinders. So volumes will definitely go up in terms of supply from the market, depending. NBC is also coming with a 2 million pellet plant, which will start with Q1. So there might be some volume pressure, but because of our quality, because of our mining capacity and the beneficiation going up, the quality we make, we have a different end buyer. Our target audience is totally different. So we don't see a challenge in terms of a performance. In terms of volume, there might be pressure. Over 12 months, there might be some lean period. But on the overall performance of the company, I don't see a challenge because of the quality we make. Because we'll be producing high grade in 2 plants and a commercial grade in one of the plants. So because of higher grade, we will always demand a higher premium that will keep our margin intact, and our customer audience will be totally different than other players in the market.
Noted. And so after recent INR depreciation, has the exports been now profitable, or it is still not? And what is the difference at which we would start export?
Today, we are selling everything domestically. We have no intentions of entering the export market at the moment because the difference is the delta is very huge. The delta is more than $15-17 at the moment. domestic demand is quite strong because in last few weeks, the entire supply chain of domestic has gone up, right from, DRI to billets to steel making. There has been an upsurge in the finished demand from the market. So at the moment, we have no plans of, exporting any pellets. We have very strong demand, and sitting in February, we are almost booked till, end of this quarter.
Noted. So my second question pertains to our capital allocation. Since now our cash inflow is going to go up significantly, we have invested in Jammu pigment, then we are doing batteries and at the same time steel. So going forward, how should we look at our capital allocation in terms of, because Jammu pigment hasn't done anything yet. So
Yes.
after batteries, our whole and sole focus would be on the steel only, or we will still take up those small pockets of CapExes because we are kind of a little bit reluctant to do a large CapEx on a single segment. So how should we look at our capital?
Jammu pigment, whatever money we've invested, we always have the option of, increasing our stake. That we can do any time. But at the moment, we have no plans to invest any more money in Jammu pigments. Jammu pigments will run independently. Whatever cash generation happens from the operations, basis that only, they will look to expand further. We have no intention of investing any further money in Jammu pigments, just to make it very clear. On the allocation side, and Mr. Dinesh ji mentioned, so our CRM, our solar and a BESS, so the outflow in this year should be close to about 2,500 crores with a strong cash reserve, with the mining capacity coming up, and EBITDA going, our cash reserve going plus from the current financial year. I think we are well versed to, meet all the capital allocation requirement. We don't see a challenge.
I noticed. And sir, I just seen in our presentation, our carbon intensity remains very high despite we using some of the solar. So after assimilating all the solar power projects, basically, what is the final carbon estimation?
See, we currently at 2.4 levels, 2.45 levels. So to reduce the carbon density, a new pellet plant, we have switched from coal gas to natural gas. That is one of the initiatives. With solar capacity adding for my captive consumption, that will further reduce my intensity. But and we are also working in one of the carbon capture projects with IIT Bombay. It's an R&D project for 5 ton capture per day. If that is successful, I think then we have a clear path to move forward. But you need to understand, for the entire steel cycle, today the major crux where carbon emission is happening is the DRI. Out of 2.4, 2.45, 1.8, 1.85 is the contribution only from DRI. So that is the area where we really need to attack if we want to bring down our carbon levels. On the power front, we have taken care. On the pellet side, we have taken care. Now the main challenge remains the DRI, where we have tied up with IIT Bombay. We are working on a R&D project of 5 tons per day. That project should be up and about by coming Diwali, which is 10 months from now on. And the results are good. Then we have a clear path how to move forward to reduce the carbon density.
Noted. And sir, just one last question, if I may squeeze in. Sir, coal cost-wise next quarter, what are our expectations? I believe we import most of the coal. So INR depreciation has hit them, and also, as well as there talks about Indonesian supply getting hampered. So your thought process?
Indonesian coals are mainly used for power plants. They're not used for DRI. But definitely it will have a certain impact on the South African prices as well, because there will be a glut in the system. So there will be some transfer of, a new buyer and new market seller, right? Our current cost in the Q4 quarter, absolute value is about 11,000 rupees of import. Our DRI contribution is 8,000 rupees. In Q1, because we do forward buying, so Q1 the cost will vary, maximum is about 5-7%. We have ensured that. So any substantial impact, if it has to happen, will probably happen, from Q2 onwards, which is almost 6 months from now on. So no point commenting about that.
Okay, sir. That's all from my side, and all the best for future.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. I repeat, participants who wish to ask a question may press star and one at this time. The next question is from the line of Manav from Yes Securities. Please go ahead.
Yeah, hi. Very good afternoon, and thank you for the opportunity. So the first question is, in the presentation, we have mentioned that roughly 452 acres of land acquisition has been done for the integrated steel plant and for the CRM complex. So what would be the CapEx outlay of the 452 acres, if you could give me the number?
To acquire the land?
Yes.
I think it's about 32 crores. Am I correct, Bothra ji?
Yes, sir.
Yeah, so it's about 30 crores. So we have signed a 99-year lease agreement with the State Industry Department, and the total outflow has been about 32 crores to acquire the land.
Okay, got it. And so for the CapEx that you mentioned for, 2,000 crores, earlier question by Siddharth ji, just wanted to know, it doesn't include any steel CapExes which are, probably going to...
No. Steel, so steel CapEx is not involved. For steel, we will first have to, internally discuss, get it approved by the board. So whatever CapEx we'll be doing right now, it has nothing to do with the new steel plant. It's CRM, about 11 crores, the battery storage, and the additional solar capacity. These are the three major CapExes which will, happen in FY27.
Got it, sir. So just, on the pricing front, can you, give us some sense on how Q4 is shaping up versus Q3?
See, on the mining side? Sorry, can you come again? On the mining? Market side. Okay, sorry. See, on the market side, fortunately, there has been quite an upsurge, in terms of prices. Pellet is up by almost 10-12%, DRI is up by 20%, semi-finish and finish is almost up by 12-13%. The demand is quite strong. And, so the change we have realized, in last couple of years is, usually we should think Q4 and Q1 are the best quarters for steel. But earlier was Q1 and Q2 for best quarters for steel. But now we have realized there's a change in terms of, demand and supply. Now Q4 and Q1 are supposed to be the best quarters before the monsoon arrives. So if you see Q2 was dull, Q3 was also very dull, and this was the trend last year as well. So Q4, the demand is very good, and we're expecting the demand to continue for at least for Q1 as well, before the monsoon arrives.
Got it, sir. That is quite helpful.
Yeah.
So on the imported coal, would it be possible to give what the current mix is for us right now, imported versus the domestic coal usage?
See, for a DRI, we 100% will be completely import RB1 coal. So that's about 0.6 million tons annually. And for our coal gas operation for pellet plant and for our power plant, we do about 0.4 million tons of domestic coal. So the ratio is about, 55 or 60-40 60% is imported and 40% is domestic. We need about a million tons annually to run entire operation.
Okay. That is quite helpful. So just, if I'll squeeze in one more question, just wanted to know, the company has acquired 4 wagons basically for logistics purposes. So what sort of cost saving are we expecting, this from this acquisition versus what the current mode is?
So see, there are two purpose to, buy 4 wagons under the railway scheme. One is with a new pellet capacity, we do realize we want to also sell pellets outside the Raipur market, for which the railway is the cheapest mode. So to ensure the rack availability and timely movement of our racks, we have acquired this acquisition, where one bag, entire rack will cost us about 24-25 crore rupees. Secondly, the scheme under which we have acquired, so there is flat 10% discount on freight for a period of 15 years. That is the scheme railway has designed. So a 10% saving will be there on the railway freight for 15 years. Plus, the most important point is the timely evacuation of our pellet volumes via rack mode.
Okay, and we can lease this out as well, right, during the... low
Yes.
demand period.
So if we feel our racks are not getting fully utilized, we can always lease out on rental basis to other companies and earn extra income from that.
Okay. Okay.
Yes.
Sure. But it wouldn't be a separate business line operation that you're...
No. This is just a part of infrastructure where we want to, move for a tiny movement of a pellet volume outside the export market. And given the situation, if the racks are not being fully utilized, we can always, rent it out to other buyers, other players who want it for better movement.
Okay.
In fact, in our disclosure, we have clearly mentioned that we don't want to enter into the logistics business. It is for the captive requirement. In idle case, only it will be leased out.
Okay.
Yeah, we have clearly mentioned in our disclosure as well.
Got it, Dinesh. Thank you so much. Sir, just one last question. Wanted to, get a fair bit of understanding on the other expenses going down by roughly 11% Q-on-Q. So could you give the reasons behind the same, please?
Can you please come again? Other expenses?
Going down, on a quarterly basis. So...
No, one was because our pellet volumes are quite low. Our pellet plant, due to that unfortunate accident, was almost shut for, a span of 40 days. So entire October, our pellet plant was not running. So there might be some contribution based on that as well, because there was no fuel burn, there was no, other items purchased. So that can be one of the reasons. Plus, what has happened is the domestic coal for power plant is towards almost rock bottom due to better availability post-monsoon. So that can also contribute on the other operating costs going down.
Got it. So primarily because of the lower pellet volumes.
Yes, exactly. Yeah, mainly pellet volumes, yes.
Sure. That's all. Thank you so much, and all the very best.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 at this time. To ask a question, please press star and 1 now. The next question is from the line of Sahil Singhvi from Monarch Networth Capital. Please go ahead.
Yeah, good afternoon. Thank you for the opportunity. My first question is, despite 6 lakh ton of pellet production, the sales that we've done seems to be pretty low. I mean, I understand some part of the pellet goes into forward integration, but still I believe as compared to the previous few quarters, we've not sold enough. So any particular reason you want to flag off on this?
Yeah, there are two primary reasons here. One was there was additional capacity of our pellet plant. There was a couple of people who also commissioned the pellet plant in the same period. So suddenly there was an oversupply of pellet in the domestic market. The steel market was very lull. There was absolutely very less demand. The sponge prices were, towards rock bottom since COVID, about 20,000 rupees. So there was a phase up in December where the demand of pellet was quite low. That is why the inventory has gone up. But since then, all inventory will be cleared in Q4 because of demand being back on the higher side. So it's just cotton analysis. At today's position, our entire inventory which is piled up in December has been already cleared out.
Right. Good to hear that. So we'll be still targeting a 3 million ton of production this year?
Yes. We are very, we might not be able to reach at probably exactly, but plus minus 5% we should be there. So our production volume guidance starting of the year, we are very much on track to achieve that.
Got it. Secondly, just the first year of operations for BESS, would it be safe to assume a 40-45% utilization, or should we assume a little lower?
No. So just to be on because it's a new vertical, totally a new field. Even we have considered a 40 to 50% plant load for the first year. So April 27 to March 28, we consider a production capacity of say 8 to 10 gigawatts only against 20 gigawatt line.
Right. And margins could be around 6%?
Yeah. So for our modeling, we have considered a margin of about 7%.
Got it.
The reason I'll tell you why is we've considered slightly higher margin compared to our peers is because we have chosen a new technology cell, which is a 620 AX cell against a 314 AX cell, which others are doing. So because of that, our operating costs will be slightly on the lower side, and that is why they hence improve margin.
Right.
So our first line will be 100% basis 628 ASL.
Got it. Thank you. Thank you so much.
Thank you.
Thank you. A reminder to all participants, to ask a question, please press star and 1 on their touchtone telephone. To ask a question, please press star and 1 now. The next question is from the line of Vineet Thakur from Plus 91 AMC. Please go ahead.
Hi, good afternoon, sir. Thank you for the opportunity. I would like to know what is our revenue and EBITDA guidance once the entire CapEx is done? What is the level of debt that we are expecting to have in the books for the CapEx?
So you're talking about next year or once all the new capacities are running at full production?
For the next year and once the capacities are all done, are live.
See, so from current operations, once so next year, once the mining will be at full capacity, our operations pellet will be at full capacity, we're looking at a revenue of close to about 6,500-7,000 crores from the steel complex. On the battery storage side, if you consider a capacity of 8 gigawatts, so you can consider revenue of 5,000 crores. And from the CRM, again, you consider 50% capacity, which is a 3.5 lakh ton. So you can consider volume of close to about 2,000 crores. So put together, anything between 12,000 to 15,000 crores will be the turnover from FY28.
Okay, sir. And so what is the level of debt that we are expecting to have in the books for the CapEx?
Dinesh?
Debt will be close to about, peak date at FY27 as of the CapEx which have been announced till date. Will be in the range of net debt will be lower, but on the gross side, it will be in the range of about 1,500 crores. With the minus cash balance, will be the net debt. That depends on the cash flow generation in the next financial year. What we have done is we have tied up a debt of 1,500 crores for all these CapEx to keep the cash on the balance sheet for our future expansions.
And the way we have negotiated with the bank is, depending on our cash flows for the next year.
We always have a choice to prepay.
Exactly. We always have to prepay, and also we will only draw when there is a requirement. So we have kept the both options open of prepayment and draw the money as and when required.
Okay, sir. And sir, I would like to know what was the impact of the new labor laws on GPIL. So our employee expenses or anything has increased drastically because of that?
See, so there will be, of course, because now with the new employee code coming in effectively, so now you have to treat your contract laborers as the same category of your employees. So there will be a very marginal impact, probably I think hardly about 7-8 crores on annual basis. It's not a very huge impact. That now the law says even your third party employees or a contractor employees has to be treated in the same way you treat your own company employees. That's the major difference. So there are change of law, the change of salary structure, which will be complied from next financial year. The impact is very minimal. Yeah, you can say about 70-80 lakhs rupees a month. That's it. Not very major.
And sir, how much free cash flow are we expecting 3 years down the line?
Very difficult because see, if you don't go ahead with the steel plant, then probably from FY28, once all our CapExes are done and the new production capacity comes up, there will be close to about 2,500 or 2,000 crores of free cash every year. But if the steel plant is shaping up and we do decide to go ahead, then for the next 3 years, all our free money will be invested in the new steel plant. So it's difficult to comment at the moment. All depends, what CapEx plan going forward.
Sir, since you mentioned the steel plant, is there any clarity on when will we take a decision if we want to do it or not to do it?
But in best possible scenario, I think by end of which will be the annual board meeting, which will happen in April and May, we will have full clarity on that. So either we are going ahead or we are not going. We'll drop it. That's very clear. Because we were waiting for the mining EC to come. Now since that has come, we are working on the last fine-tuned details. And I think by next board meeting, either we'll take it up or we'll drop it. That's for sure.
So what's the expected capex for the steel plant if we do go ahead? And what will be the capacity for it? you're thinking?
Capacity will be 1 million, and the CapEx we envisage should be somewhere about 5,000 crores.
Okay, sir. Thank you, sir.
Yeah.
Bye.
Thank you.
Thank you. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. Participants who wish to ask a question, please press star and one at this time. The next question is from the line of Aryan Bhatia from Inved Research. Please go ahead.
Thank you for the opportunity, sir. My question is on the incremental sales volume. So please correct me if I'm wrong. So the incremental sales volume, once both iron ore mining and pellet come, will be 2.7 from the pellet plant and 0.5 from the beneficiation plant. Is my understanding correct?
No. So firstly, we will not be selling anything out of a beneficiation plant. Beneficiation plant is being put up to enhance the quality of concentrate, which will feed to a pellet plant. So there will be nothing sold out of beneficiation plant. It's part of our internal process. On the pellet side, which, if you do a volume of say 4 million, so out of which about 1 million will be for captive consumption and 3 million will be for merchant sale.
Okay, so out of the 4 million, 1 million for captive consumption and 3 million.
Yes, whatever. So we produce 4, we produce 4.2, 4.5. Whatever we produce over above 1 million, that will be for completely merchant sale.
Okay. And so my second question is regarding on margin on the CRM complex. So what is the EBITDA margin you're expecting? Because we will be buying HR coils from outside and...
Yeah, see, so it's more of a... Exactly. It's more of a conversion business to make value-added steel. We have also filed for 2 PLI schemes under the new scheme by Steel Ministry. So on a year-on basis, I see a EBITDA operating margin level at about 8 to 10% on the maximum side, 8% to 10%.
Just wanted a clarity on this margin, because if I look at the HR coil prices, it's around 51,000 and CR coil is around 57,000. Shouldn't the gross margin be 10% as compared to EBITDA margin?
See, on papers, you are very correct, but we are getting into value-added steel. A lot of branding, a lot of marketing will be required. We have to educate our customers because we will be competing against the, all established players like the JSW, Tata and all that. So that's why, to be very conservative for initial couple of years, to establish ourselves as one of the leading players with the desired quality, we have considered the margin on the slower side. Once you establish, you can definitely consider 8-10% on the gross profit margin side, definitely.
Okay, got it. And sir, last question is on our best projects. Can you give the unit economics for the best, per gigawatt of revenue we can get?
See, today, per megawatt hour of the entire setup to deliver at site for usage by a buyer is about 80 lakh rupees per megawatt hour. So it makes one container at about 4 crore rupees. So at a first year of 8 gigawatt, you can easily multiply, 8 gigawatt into 80 lakhs. So it becomes close to about 6,500 crores of revenue with a operating margin of about 7 to 8%.
Got it. Thank
so
you.
So on a 6,000 crore, 8% comes to about 450 to 500 crores.
Got it. Thank you. That's all my side.
Thank you.
Thank you. A reminder to all participants, if you wish to ask a question, please press star and one on your touchtone telephone. To ask a question, please press star and one now. The next question is from the line of Siddharth from Equidays. Please go ahead. Mr. Siddharth, please proceed.
You can take the next question. I think he's not there in the call.
The next question is from the line of Abhi Shah from Siddhi Technology. Please go ahead.
So I have one question. What is the difference between BF pellets and DR pellets, and what is the mix?
Please complete the question. So sorry.
So what is your mix in producing BF pellets and DR pellets? As you said in one of your remarks that you have higher quality of iron ore. So does it mean that you have higher DR pellets mix in your production?
Okay, so to clarify technically first, basically there are two DR pellets. One is the coal-based DRI sponge, which we operate, and one is the gas-based DRI, which is being operated by, mostly Middle East and few European countries. Even SR Hazira, Archimetal Hazira is doing the same thing. So to make a DR gas-based pellet, the major difference comes in the physical parameters, which is one is the sizing. So for a BF pellet or a coal-based DRI pellet, the size you produce is 5 to 18, where for DR pellet, you need a size of 9 to 18. That is a major change. Secondly, the strength of BF pellet, there's a parameter called CCS, which is a coal crushing strength. So for BF, 220 plus is more than enough, but for gas-based DR pellets, you need a minimum of 270 to 80. So that is where, the challenge comes to maintain that physical parameters. And that's the reason you get a substantially higher premium in the export market compared to a BF pellet. So for example, today, a BF pellet premium for a 6580 pellet is hardly about $13, whereas for a DR pellet, the premium is as high as about $28. So that is where the difference is technically between a BF pellet and DR pellet. In our case, since there is a strong demand from the domestic market, so we have no intentions of, making the DR pellets and exporting to Middle East. We are always have the option to doing that. But at the moment, looking at the current domestic demand, we will keep making BF pellets, which are equally suitable for DRI sponge iron.
Okay. Yeah, that worked.
Thank you.
Thank you. Before we take the next question, we would like to remind participants that you may press star and one to ask a question. Participants who wish to ask question may press star and one now. The next question is from the line of Manav from Yes Securities Limited. Please go ahead.
Yeah, hi. Thank you once again. So, my question is, pertaining to the BESS. So, you just mentioned that for the first year we would be running at a 45 to 50%, utilization level. I wanted to talk about the second phase of BESS. Will we take the expansion post the first year of running and seeing how things are going on, or will it be, being done simultaneously?
No. We gotta be little cautious, because it's totally a different field. There will be huge competition. So, we will only invest into the second phase once we are able to stabilize the line for the first phase.
Got it. And what would be the timelines that, I think for the brownfield expansion now, it would be a lesser period, right, which would be taken up?
Yes. So probably just to commission the second phase will take about maximum about 8 to 10 months. That's it.
Got it. And so, second question is, could you just give me how the ferroalloy market is shaping up in terms of pricing? I think, the prices have been quite steady over the last 6 months. How do we see it going ahead?
Yeah, so ferroalloy prices has been hovering, 70,000 plus minus 5% benchmark. On the lowest side, it went to 68,000 when the market was lull in Q3. And today when the market is good, the prices have moved up to about 74,000. So ferroalloy for the entire year has been operating at, 70,000 plus minus 5% range. And I feel this will continue. So since the market is good right now, I feel the prices should be about 75,000 for, a few months going forward.
Okay. That is quite helpful. So one last question. Wanted to know, there have been discussions about expanding the Boria Tibu mine. So what's the management's view on
We have full plans to expand the Boria Tibu mines. We have commented earlier as well. The mines being low grade, so we have to put up a beneficiation plant inside the mines, for which a substantial area would be required. So we have already started the process of preparing the TOR to file for the new EC along with the beneficiation plant. So we see that plant up and running in say FY30, which is 3 years from now on, bare minimum.
Got it. And have you applied for the
No, so the documents are under preparation. We have finalized how we want to run that mine along with beneficiation. So the TOR will be filed in Q1 of next financial year for the new EC. So you can consider about 12 to 12-15 months of EC period, and then another 15-20 months of plant erection. So 3 years from now on.
Okay, got it. And this would come regardless whether we proceed ahead with the steel plant or no, right?
Yes, definitely, because today my pellet requirement for my pellet to feed my pellet plant, I need about 5 million tons of, concentrate. So it's always, nice to have a backup of 1 million ton of same grade from a different mine. So if you don't put up the steel plant, this will, be an alternative source. So if there are, some challenges because of public in monsoon or something, we can always, feed the mines to the pellet plant.
Okay, and what capacity expansion are we planning from 0.7 to what?
4 million.
4 million.
So 4 million, 100% 4 million beneficiation. So the output of concentrate will be close to about 1.5 million tons. At 40% recovery.
Got it. Yes. That was very helpful. Yeah. So thank you so much.
Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. I repeat, to ask a question, please press star and 1 now. The next question is from the line of Shikhar Mundra from VVCorp Commercial Limited. Please go ahead.
Hi. So for the expanded pellet capacity of 4.7 million tons, what is the corresponding iron ore which we require?
Sorry, come again. You were not clear.
For the expanded capacity of 4.7 million tons of pellet, what is the iron ore which is required to make that?
Okay, so on actual table basis, we need about 5 million tons of iron ore. But to make that 5 million tons, we will have to beneficiate the 6 million. Sort of 6 million, we about 15 to 20% there will be yield losses to upgrade the quality of iron ore. So from 6 million, we'll do about 4.75 tons of concentrate, which will be sufficient enough to feed my entire pellet plant.
Okay, so the entire 6 million tons of iron ore capacity will be used. I mean, we won't have extra to sell.
No, we have no. We rather than selling, we would like to, public extend a mining life. We have no intention of, because I'll tell you another reason, because if we happen to sell in the market, as per the new MMDR Act, because our mines was allotted in the captive category, we are allowed to sell 50% apart from a consumption, but then we have to pay additional royalty. So the royalty amount will be 1,000 rupees plus. So does it make sense to sell addition? But better to reserve and extend a mining life or have a buffer stock if something goes, haywire in the mines because of extended monsoon or, it can be anything there.
Got it. And post this expansion letter on 4.7 million tons, what will be the split between high grade pellets and low grade pellets?
So on the split will be about 70% will be high grade, 30% will be low grade.
And on what is the current split?
Current split is again it's same. So current split is about 65 is high grade, 35 is low grade. So one plant will continue to remain like that. The two bigger plants will keep producing. Sorry, the ratio will change to 80%. So 80% will be high grade, 20% will be low grade. My apologies.
Okay. So our margins, we are expecting our margins to slightly improve.
Exactly. So whatever challenges you're going to face from the pressure, the supply side because of Lloyd and other competitors, we will very much negate that with our quality and higher premiums.
Got it. Thank you and all the best.
Thank you so much.
Thank you. The next question is from the line of Devesh Shah from Sri Polymers. Please go ahead. Mr. Devesh, please proceed with your question. As there is no response, sir, can we move to the next question?
Yeah.
The next question is from the line of Siddharth from Equirius. Please proceed.
Hi, sir. First, on the mining side, now with the expanded capacity and ramping of the mines, will there be some change in the cost structure given the operating leverage that would be coming in? How should we see the mining cost moving over the next 2 years?
See, the mining cost should remain on the similar level. Primarily, there are two reasons. One is because of additional mining, our mining cost will slightly go up because the way our mine says, it's not a very open cast, flat land. We are going well below the sea level. So currently we're mining at about 100 meters. And to reach 6 million, we have to probably reach about 140, 150 meters. So our mining cost will go up. That will be compensated by the volume, the solar plant we have established, the new battery storage, as well as the beneficiation. So we still expect the mining cost to be at 3,000 levels in the longer term, which is currently right now.
Okay. Secondly, with all the power projects coming online in the next 2 years, what kind of cost savings would we have on the energy side?
See, on mining side, today the grid tariff is about 11 rupees, which will be replaced by a power of, say, 3 rupees. So on the plant side, the grid tariff is about 7 rupees, which will be raised up by, 3 rupees. So on total put together, our annual cost, average cost of generation, which is currently about 3.75 rupees, should be well below 3 rupees.
So the payback should be less than 2 years for the entire solar project?
No. So for mining, the payback is about 3 years. But for my plant side, the payback is about 4.5 years because the tariff is on the lower side.
Oh, okay. Got it. Thank you so much.
Thank you.
Thank you. The next question is from the line of Devesh Shah from Sri Polymers. Please go ahead.
Yeah, ma'am. After all expansions, what could be total turnover of the company in 2020, 2030?
2030, sir?
2030. Yeah, 2030.
Total turnover of the company, right?
Yeah. Expected,
Okay.
I mean.
Yeah, of course. I do understand that. So the total turnover of the company, so I'll tell you, 7 plus 15, roughly at about 25,000 crores.
Okay. Okay. Thank you.
Yeah. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand over the conference to management for closing comments. Over to you, sir.
Thank you, ladies and gentlemen, for joining us on this call. We hope we have been able to answer all your queries. In case you have any further questions, please get in touch with us or to our investor relation team. Thank you very much. Thank you. And with this, you can this call. Thank you very much.
Thank you.
Thank you.
Thank you on behalf of Go India Advisors LLP. That concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.